Hey traders, so we're going to run through a quick market breakdown of the S&P. As you can see, it's getting quite a strong rally going here. So I'm trying to determine where we see this thing going. So basically what we're looking at here, in my view, is we have this impulse to the upside, and all of what we saw heading into the start of the crash, the quote-unquote crash, was all corrective price action, and what we determined to be an expanding triangle. So using these lines, I'll show you what we're looking at as expanding ABCDE, expanding triangle. And using some Glenn Neely terminology, he would call this what's called a non-limiting expanding triangle, given the length of this area compared to the rest of the triangle. And what that means is, although it is possible, it's unlikely that this move is going to retrace all of this move. So we have been calling for new highs for the S&P, but upon reflection of the trade, we've decided to withdraw those calls. We still think we're going to get a healthy rally, and we suspect what we're going to get is probably a rally towards the 3,000 to 3,150 mark, somewhere in this area. And ideally what we're looking at is some key shares that are going to be good indicators for us. The first one being Apple. Now Apple we see going to new highs because of its correction, is what's called a running flat, and this running flat is a good indication that this move up is going to break the highs. But given the current market conditions, we feel that this break of the highs is going to be temporary, and once we see it, we're going to see a turn. A good indication, another one, is Amazon. Looking at Amazon, we have a similar structure, and as we can see, price really on the move and really looks like we're going to break the highs already. So I think first we're going to see Amazon break the highs, then we're going to see Apple, and that's when we're going to start to look to take risk off the table. And after that, if things start to climb, the big elephant in the room will be Facebook. And given this is the one that's lagging, but it's still in a running correction, it's a bit of a weaker running correction, we suspect that this will be the stock that hits new highs and becomes the catalyst for the big fall. And once we see this fall, we're going to see a really big fall. So going back to the S&P 500, we see what we're looking at is, on a classic charting point of view, we're looking at a left shoulder, a head, and a right shoulder, which we expect to again come towards this 3,000 to 3,100 level. And that's our right shoulder. And if this does play out, classic chartists say that the move to the downside following the break of the neckline is going to be steep. And we could see moves as low as 1,000 on the S&P. And it looks like we're going to head back to kind of the 2009 levels, which is a scary thought. But given the conditions of the market and how basically the US is shut down, it's not unlikely we're going to see that. We're talking Great Depression here and a lot of economic damage caused by this virus. So this initial rally, we feel, is going to keep showing strong. It might reach new highs. We might start to see the buy the dip crowd get sucked in here. If the buy the dip gets sucked in, we're going to see some steepening of this rally. Could really pick up quickly. We also have the passive guys who are looking to buy this, and they see the market moving. They want to get back in, expecting this thing to carry on going. But on the broader spectrum, we're looking at this as, this chart doesn't show you all the data, but kind of Elliott wave coming into play here. We're in the fifth wave. We could see a fifth wave failure. We could see the fifth wave just break the highs, but we don't see this fifth wave being long and drawn out. We expect it to be nice and quick, and then we're heading to the downside. Heading into the lower time frames, we can have a look at what's happening and what's to be expected. Just get rid of this. Lower time frames are saying, depends how you look at this, but what I'm expecting heading into a long weekend, a lot of traders with the volatility are going to want to be out of this market. So let's just see the highs 2638.7, 2641. So this was the highs. I expect that to be the impulse of this move. This is a corrective impulse, and it's not very choppy, but it's choppy enough to be called a B wave. And I expect heading into the weekend, we're going to see a bit of a sell-off. And then come Monday morning, those buyers are going to come back into the market before we see the next move up. So that's something we'll be looking out for and keeping a close eye on this market. This market's on the move. Another option for this is, we've already seen the correction, and it was just really simple. I don't like the price action. It's too simple to be a correction, but it is possible given the manipulation that's going on in this market with the Fed announcing stimulus and things along those lines. It's also possible that this is all the correction we're looking at. And if we do continue to rise, we still see this 2900 area being of significance. And just pulling back, we can see why. Don't usually trade support and resistance, but given the circumstances, there's some good clean lines here. So 2900, really interesting level, but we don't see it as the big turn to the downside. Probably see another correction, maybe a bit of a bigger one, something along those lines, and we'll head up into the next area, 3100, 3150, somewhere around there. So yeah, stay nimble. There's some profit to be made on this market. You just got to be careful because there's a big drop coming. If you trade options, it's a good time to start buying puts, start averaging them in, kind of long dated puts. I think you should get some good. The VIX is coming down, so you start getting some good price on that. So yeah, we feel like that's a really good trade. So cool, that's us for today. If you guys are interested, check out senecalytics.com. We're setting up our trading academy, teach you guys how to trade and teach you how we caught this top, how we pulled off risk on the 9th of Feb before all of this happened, and how we put it back on right at the bottom. We called both the top and the bottom of this market, and we're looking to call the new tops on this. So stay posted. Cool, guys. Stay nimble. Much love. Ciao.